Welcome back. Here's a look at where markets ended the week, with the S&P 500 and the Nasdaq closing out February at another new record high on Thursday. This coming as the Federal Reserve's preferred inflation gauge came in at the lowest level since March of 2021. But we are not out of the woods yet. The chief investment strategist at the world's largest asset manager, BlackRock, is warning that prices may go back up by next year before ultimately falling once again. Joining me now is the Lonski Group founder and president, John Lonski. John, great to see you. Thank you so much for being here. Let's talk macro story here and inflation, because one of the underlying issues here has been the price of oil, right?
Correct. And it's moving higher. As I'm speaking right now, it's approaching $80 per barrel.
Oil prices will stay elevated given the fact that people are worried about supply. You've got the U.S. and its climate change agenda cutting off fossil fuels. But isn't that a worry that will keep inflation elevated overall? You've got the essentials: food, fuel, and rent, shelter. Still elevated, even though we're way down from the highs.
You bet it is, Maria. I mean, let's face it, one of the reasons why we had this dramatic slowdown by price inflation is because of significantly lower oil prices. When inflation was peaking, the price of crude oil was $100 per barrel. It came down to about 70, and now it's moving back up towards 80. If we no longer have energy price deflation, chances are we are going to be looking at faster rates of growth than otherwise for both the PCE price index as well as the core PCE price index. Energy matters greatly for prices other than just energy products.
And yet we see growth in the economy. We had the GDP out. We've got growth, even if it's lower than what we saw a few quarters ago. And you also have an earnings season, which is getting finished up here, which was largely better than expected. How would you assess the economic story right now?
Ordinarily, growth is a good thing. But let's face it, right now, we have a tight labor market. We have a historically low unemployment rate, 3.7%. But what's troubling about this low jobless rate is the rapid rate of wage inflation. That's now running at 4.5%. Chances are, if the economy continues to grow at a rate of roughly 2% or faster, we are going to see a further tightening of the labor market, and with that, even faster wage growth. And that's going to be bad news for inflation, especially consumer services price inflation. If we want to get inflation under control, we've got to get wage growth down to something close to 3%.
That's a good point. What does that mean for the Federal Reserve, John? Are you expecting rate cuts this year?
Unless I see a substantial slowing of the U.S. economy, a marked deceleration of spending, unless I see a rise in unemployment, the unemployment rate above 4%, and unless I see jobs growth coming in at fewer than 125,000 jobs per month, no, there will not be a rate cut in 2024.
Well, if there's not a rate cut in 2024, isn't it likely that we see a stock market sell-off? I mean, isn't that largely the reason that we're seeing so much euphoria around stocks?
That's precisely right, Maria. If we don't get this rate cut, there's going to be a lot of disappointment on the equity side, and I would imagine some of these richly priced equities are going to be moving lower in terms of price.
All right, we will be watching all of that. Thank you so much, John. Good to see you.
Thank you, Maria.